We all dream of living our golden years in comfort and financial security. Retirement accounts are designed precisely for that purpose, to help us invest and build wealth for our retirement. However, the IRS has put strict rules in place to discourage early withdrawals from these tax advantage accounts. But fear not, as we'll explore how the Rule of 55 can provide a penalty-free path to early retirement for those who qualify. Welcome to the Finance Virtuoso Channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit that subscribe button now. Today, we'll be diving into the world of retirement accounts and a lesser-known option for early withdrawals called the Rule of 55. Let's jump right in. Understanding the Rule of 55. The Rule of 55, set by the IRS, provides a special chance for employees who quit their jobs to access their current employer's retirement plan penalty-free once they turn 55 years old. This is particularly helpful for individuals looking to retire sooner or needing urgent financial assistance. Deciding when to make these withdrawals is crucial for budgeting your retirement funds and managing tax obligations. It's important to stress that the Rule of 55 isn't for every 401k and doesn't include traditional or Roth IRAs. While many companies include this provision in their retirement plans, it's not a guarantee everywhere. Some view it as an incentive for employees to remain with the company, although this can sometimes lead to depleting retirement savings prematurely. Meeting specific conditions is necessary for using the Rule of 55. 1. You should exit your job the year you turn 55 or older. This applies to retirements or layoffs. If you're in public service and turn 50, you're also eligible to withdraw from your current 403b or 401k plan without penalties. 2. Once you've retired early, initiating withdrawals is no longer possible. Not all employers support early withdrawals, and even those that do might require a lump sum withdrawal. Also, always check your retirement plan's policies before proceeding. Under the Rule of 55, penalty-free early withdrawals are confined to the most recent 401k or 403b plans. Past 401ks are excluded from this provision, and the same doesn't apply to individual retirement accounts or IRAs. If considering early retirement, consider rolling old retirement funds into your current 401k for access under the Rule of 55. The specifics of your retirement plan matter. 1. Your company's plan must offer a 401k or 403a or b that allows Rule of 55 withdrawals. Some may even mandate waiting until 59 and a half or even 62 before withdrawing. 2. Funds must stay within the employer's plan until withdrawal. If you move them to an IRA, you lose Rule of 55's tax protection. Understanding the potential missed investment gains is crucial. Early withdrawals might mean forfeiting potential earnings on investments. Additionally, the timing of withdrawals can affect your tax obligations. If your taxable income would be lower in the next calendar year, consider waiting before beginning Rule of 35 withdrawals. For qualified public safety workers, a special provision allows starting withdrawals 5 years early, applicable to police officers, firefighters, correctional officers, and more. This applies to those who turn 50. The Rule of 55 outlines when and how you can access your retirement savings, and it's essential to follow these rules. Mistakes could lead to a standard 10% early withdrawal penalty, along with taxes on previously untaxed funds, like Roth account earnings. Should you consider the rule? Considering whether to utilize the Rule of 55 is an important decision that depends on your individual financial circumstances. You might be contemplating this option, but uncertain about whether it's the right choice for you. Ultimately, Determining whether early withdrawals under the Rule of 55 are suitable hinges on your financial situation. To make an informed choice, you need a clear understanding of your retirement plan's rules, the amount you need to withdraw, and the projected annual expenses during your early retirement years. Addressing these factors can guide you in deciding if an early withdrawal aligns with your needs. The Rule of 55 could prove pivotal for those contemplating early retirement, especially if circumstances like unexpected downsizing prompt the need for immediate funds for medical bills or mortgage payments. While the common advice is to maintain funds within your plan for as long as possible, there are instances where tapping into these funds makes financial sense. It's worth noting that IRAs and 401ks from previous employers don't qualify for the Rule of 55 exception. However, by rolling these funds into your current 401k, you can expand your access to a larger savings pool before turning 55 and a half. Yes, it's important to consider the timing of your withdrawal. For instance, making a withdrawal in the same year you retire can increase your taxable income, potentially pushing you into a higher tax bracket. Waiting until the next January after leaving your job could reduce your tax liability. Concerns about how early withdrawals impact credit scores often arise. While withdrawing from your 401k doesn't directly affect your credit score, using the money to pay off debts can indirectly influence it. This shouldn't be the sole reason for withdrawal, except in cases of financial emergencies after exploring all alternatives. There are valid reasons to consider using the Rule of 55. If retirement is your goal, following this rule can provide the necessary funds to cover expenses. If you intend to return to work later, you can still make necessary withdrawals without the 10% 401k penalty, although regular taxes do apply. Taking early withdrawals acts as a financial safety net if retiring before age 59 and a half. Conversely, patience in seeking additional work or part-time employment can allow your funds to grow tax-deferred into your 80s. Alternatives to the Rule of 55. While the Rule of 55 is a viable option, it's not the sole route to penalty-free withdrawals from your retirement plan. If you find yourself leaving your job before reaching the age of 59 and a half, there's an alternative method to access funds from your 401k, 403b, and even IRA retirement accounts. This alternative approach is known as the Substantially Equal Periodic Payments, or SEPP exemption, also referred to as IRS Section 72T distribution. The SEPP plan operates differently. It starts by estimating your life expectancy, a somewhat challenging task. You then use this estimate to calculate 5 equal payments from your retirement plan for 5 consecutive years, ending before you turn 59 and a half. A distinctive aspect of these distributions is that they can occur at any age, without adhering to the same age restrictions as the Rule of 55. You have the flexibility to apply the SEPP plan to any qualified retirement account, except a 401k held at your current employer. Setting up the SEPP arrangement requires the assistance of a financial advisor or can be done directly through a financial institution. At the outset, you must choose one of 3 IRS-approved methods for calculating your SEPP distributions: amortization, annuitization, or required minimum distribution. Each method yields a different calculated annual distribution. However, once chosen, the amount we withdraw remains predetermined and unchanged annually, at least with 2 out of 3 options. The IRS recommends selecting the method that best aligns with your financial circumstances. You can modify your chosen method once within the plan's lifespan. Should you opt to cancel the plan before the minimum holding period concludes, you will need to repay all IRS penalties waived on the plan's distributions, including interest. Numerous factors require consideration before making early withdrawals from your accounts. encompassing life expectancy, taxes, savings, investment accounts, and more. If you're contemplating the use of the Rule of 55, consulting with a financial advisor is wise to ascertain if it's the optimal approach. There you have it, folks, the ins and outs of the Rule of 55 and early withdrawals from retirement accounts. While the Rule of 55 can be a game changer for early retirees, it's crucial to consider all the factors involved. Remember, retiring early is a personal decision that depends on your specific financial goals and needs. Be sure to seek professional advice from a financial advisor to make the best choices for your future. If you found this video helpful, don't forget to give it a thumbs up and share it too so more people can have access to helpful financial tips and insights. Until next time, thank you for watching.